Good afternoon. This is Tom Alexander. It is Sunday, May 21st. It is 2:45 p.m. Eastern Time in beautiful Charleston, South Carolina. This is the video addendum to the written report that I send out every week. It is a free report. If you are finding me on YouTube and you would like to receive the free report, this week's report, as well as future reports that are free, send me an email to tom@alexandertraining.com. Also, if you find value in the video, please subscribe to my channel. Please like it. And if you have any comments, please comment. I'll try and respond to every single comment. Okay. Are we in a new bull market? We could be. And we're going to take a look at what needs to happen to confirm that. Right now, it is not confirmed. So let's just dive right into some charts. And we're going to start with the weekly charts of the cash indices, the SPX, the NDX, the Dow, and the Russell 2000. And we are now in the 32nd week off of the October lows of the indices. Now, they're slightly lower lows, but the October 10th lows were basically the lows, the week lows in this bear market so far. Now, did that begin a bull market? We may have. Okay, in the last 32 weeks, we have risen 17% in the Dow, a little over 20% in the SPX, almost 33% in the NDX, and not quite 8% in the Russell. Now, if you look at these charts, it's obvious. A few things are obvious. The Russell is underperformed. The NASDAQ is it's up 33% since October. That's a bull market itself. You can't deny that. It's making higher highs and higher lows. The SPX the performance in the SPX is second to that of the NDX and is highly correlated with the NDX because of the mega cap stocks that are in both indices. I think I saw a report that 95% of the gain in the SPX this year is because of 6 stocks. And if it's more than 6, it's not many more than 6. The Dow, you can see, is up 17%. And the Russell is the index that continues to confound. Now, you may look at this and say, well, gee, Tom, it's obvious we're in a bull trend, but there's something I want to point out. I want to point out what typically happens at bear market lows when a new bull trend has begun. And let's just take a look. Let's start with 2002. Okay, so I'm going to pull this up. These are the 2002 lows that occurred. This was in March of 2002, and this was the low. This was the 32-week period, the same 32-week period we have now. Now, a few things I want you to notice here. I want you to notice, look at the market structure over here. Look how disparate it is. And what I mean by market structure, look at the main pivots and the swings up and the swings down. In particular, look at the Russell. I mean, the Russell, again, it's not even up 8%. Now look at this. Now it's true, you had some relative outperformance. The NDX at the bottom here after the first 32 weeks was up 78%. Okay, that's a lot, and it's a lot more than the Dow. But if you look at the structure of the Dow, you look at the structure of the NDX and the Russell and the SPX, they're all pretty much the same. Now, you had a deeper initial retracement in the other three than the NDX after this first thrust up. But the first thrust up was all 4 indices participated in that first thrust up. And then you had the retracement, and it held in various stages, and then you were off to the races. And then at the 32-week point mark, which is where we are now, this is where the indices were. I have highlighted where they were, and this was the gain: 78% in the NASDAQ, NDX, 44% SPX, 38% in the Dow, and 68% in the Russell. So this is a very, very different picture following an obvious what we know now because of benefit of hindsight. This was a bear market low. And this was the initial explosion off of that low was identical in all the indices. Then the retracement was a little bit different, and then you had another leg up. But the structure along the way was identical. Okay, what about the 2009 low? Let's take a look at it. Okay, here's the 2009 low. And I have highlighted the 32-week levels that were reached to use the same time frame that we're in now. The S&P, the SPX was up 63%. The NDX was up 67%. The Russell actually led the charge back in 2009. It was up 80%. The Dow was up 56%. So once again, you see some outperformance, some stunning outperformance, really, if you look at the Russell. But what you also see is the structures are almost identical. The weekly retracements the timing of the weekly retracements were identical. The resumption of the trend was identical. So that's something that we don't have now. We don't have that in these markets. Now, what would it take to get it? Well, it's pretty simple. You've got to have continued strength in the SPX. Now, the SPX, I'm going to go to the daily charts for this particular point. And the SPX is flirting with that 4,200 level. It exceeded it by a few ticks last week and then closed below it to end the week. The next level in the SPX is around 4,300, from 4,300 to about 4,326. The next level in the NDX is up here, 14,227, 14,354. And again, I have put these charts and I've put these levels in the written report. So if you want that report and you're not getting it, shoot me an email at TommyAlexanderTrading.com and I'll get it to you. And then I'll go to the Russell last. And here's the Dow. The Dow is stuck between pivots of various degrees, but I'm least concerned with the Dow than the other three indices. The Russell is the one that absolutely has to catch on fire here. We need to see strength above 1813 if indeed we're in this ripping multi-year, a new bull market that began last October, and the Russell is just late to the party. Now, if the Russell does begin to show some strength, it doesn't mean the others won't go up as well, but you should begin to see the Russell outperform. So we need to see the Russell begin to show some strength, and that will be reflected in breadth. Now, breadth is most highly correlated in the Russell. Why? Well, that's easy. It's NYSE breadth is not includes some companies that are not in the Russell. However, they're very highly correlated because they're very broad measures of market behavior. Speaking of breadth, let's take a look at this. Okay, here's breadth. Now you have you can see what this is reflecting is a huge weakness in breadth against this high. The market has gone higher and higher and higher, driven almost entirely by the mega cap tech stocks that comprise the majority of the capitalization of the NDX and are a substantial part of the SPX. But you can see the broad market, which the NYSE represents. The 10-day moving average of advancing issues is abysmal, as is the 5-day, considering where these moving averages of advancing issues were at equivalent levels along the way. I mean, this shows you that something has to give here, and it will. We're going to see a shocking move to the upside rather soon, or we're going to get some sort of retracement, some sort of relatively deep retracement into this range that began back in October. How much of a retracement? I don't know. I don't play the magic number game. The obvious level and the SPX is 40.46. Why 40.46? Because it's a level that the market itself has defined. There was a bottom on the 26th. There was a bottom on the 4th. So that's the level to keep in mind. Now, there's also a secondary level, and again, this is in the report. This was a balance area. We broke to the upside of the balance area. So you would ideally like to see this breakout level around 41.43 hold on some sort of downside move. So it will be, if we do decline and we reach this level, this will be the next test. Okay, let's look at, of course, just real quickly, VIX. VIX spiked up a bit on Friday, but it has generally held below 20 with one exception since the end of March, which is not a big surprise, I guess. Okay, let's take one more look at breadth on a shorter term basis and how we can use it. So in a bull trend, and I'm going to keep this short. I go through this over and over and over again. You can go back and you can look at past reports and you can see my comments on this. They're very consistent. We had what could be a momentum peak on the 17th. Now, if this is a momentum peak and a kickoff to a strong move up, it's a really weak one. This is a very tepid expansion in breadth relative to what you see on a strong breakout of balance that's going to continue for days or weeks. Now, the market next week, if there's some exogenous wonderful news that comes out, you could have another expansion in breadth that exceeds this one. That would be immediately bullish and portend immediately higher prices, and would definitely go on the bullish side of an important low being in place. Likewise, if we trade up in here and make a higher high, and breadth cannot get above this level, then it will be interesting to see how deeply we pull back following that divergence. Because one of two things has to happen here. One of the two things will happen here. You're going to see another immediate expansion in breadth that's really strong and takes out this level. Or you're going to see breadth that maybe it picks up somewhat, closed on Friday at right around negative 600. Maybe it gets up to plus 1200 as we make new highs, and that's it. And then it rolls over again. Now, a third scenario actually is if we just roll over from here down into this area. That could happen too. So that's something that we'll be watching very early in the week, specifically on Monday, to determine what's going on here and where is the next 5-6% move. But it seems like I say this every week, and I've been saying this every week for 2 months. Something has to give. We have this incredible ongoing divergence disparity among the indices, this incredible divergence with the NDX leading the market higher and nothing else participating so far. So we're getting closer and closer to that tipping point. My advice to traders is the same thing that I'm doing. I'm not sure what's going to happen here. I think there's going to be an extremely sharp move up or down. Believe me, there will be time once we have better evidence of what's going on to position in the right way. If you choose to play a bullish bet or a bearish bet here, and I have a bearish bet on, a very small one, but so I could be wrong. I'm just full disclosure. But regardless of your particular orientation here, bullish or bearish, if you do have a position on, I would really suggest that you being lighter than normal. And also, always know not having a position is having a position. You guys enjoy the rest of your weekend.